Here is Quentin Hardy, Forbes magazine, Kudlow and Company contributor Don Luskin of Trend Macro, CNBC contributor Vince Farrell, Soli Securities, and Kudlow and Company contributor Jerry Bowyer. Hello, everybody. You know, Quentin Bowyer, you're probably the least optimistic on this panel, so I'm going to go to you first. Anyway, it's good to see you. It's been a while.
Good to see you.
I've been away, you've been away, etc.
Right.
One of the things that Art Laffer mentioned to me is that the yield curve, right, the long-term Treasury minus the short-term Treasury, is nicely upward sloping. For 18 months, from the middle of 2006 to the end of 2007, it got inverted. The Fed got tighter and tighter, and no surprise, a recession or a slump occurred. Now, however, with Treasuries about 4% and Fed funds at about 2%, that upward sloping yield curve, if you look through the front view mirror, is very bullish for banks and financials and for future economic growth. That's why I'm getting so excited, Quentin. That's one of the reasons. What's your take on the yield curve? What's your take on today's GDP? What's your take on Goldilocks holding my hand?
You got a mighty big tingle there, Larry. It's like you're having 6 birthdays at once. But, you know, let's face facts. The GDP number was terrific, and you and I were both wrong maybe about Ben Bernanke. A weak dollar had a lot to do with it. Exports were half of the growth in this quarter. And, you know, don't take it from me. Take it from the chief economist of the U.S. Chamber of Commerce. The guy is not a left-wing crazy, and he said this is kind of the last hurrah for the economy before we enter a tough period. Now, I love this yield curve stuff because the banks can maybe earn their way out of the problem that is at the heart of the market problem. But let's not kid ourselves that this is all over tomorrow.
Don Luskin, though, I think it is all over, by the way, this slump. Don't agree with our friend Quentin. But, Don, you know, everybody always says, oh, the cheap dollar is causing exports. First of all, the dollar has been rising in recent months, and business orders...
Not in that quarter, Larry.
I understand, but follow me through. That is a view that, you know, I know. What about American competitiveness? What about American productivity? Why don't we give the American worker any credit? In other words, this idea that cheap money, Don, is the only way for us to sell overseas bothers me. And I want you to respond to Quentin Hardy.
Well, I agree with you. You know, nobody's going to buy something from the United States just because it's 5% or 10% cheaper than you can get it from someplace else. They're going to buy it from the United States because it's better. You know, and that's all there is to it. You know, that's why we've had an export boom, you know, building in this country for a long time. Now, it's been overshadowed by the fact that we've been importing a great deal, too. But we're such a great, wealthy nation, we have to import more than we export in order to give our poorer trading counterparties the dollars to buy our exports with. So this is all fitting together very, very nicely.
Why did our exports shoot up and imports go down when the dollar was weak? You think that's a coincidence?
But the trade balance, the negative trade balance is what shot up during dollar weakness. So that's the exact opposite of what you just said.
Do you think it's a coincidence? Imports were down and exports were way up.
Yeah, but so what? Look, can I ask a question here? Then let me get this right. Argentina should have been the power of the world because of their devaluations policies, or Brazil,
Zimbabwe,
or Zimbabwe.
Hey man, I don't think it's great.
Jerry Bowyer, pick up on this. You know, Jerry, it's funny. People say exports with this sort of evil slur. If you look underneath the export numbers, we're producing capital goods, consumer goods, industrial machinery. These are actually long-term themes. Our friend Stephen Abrams has talked about this for years. We are actually helping to build the global infrastructure. I don't think it's reliant on an excessively cheap dollar. In fact, the dollar, in some sense, is moving with the economic growth. I think it's good news. You know, exports create the highest wage jobs. Jerry, did you know that?
Yeah, I did know that. Look, the 1990s were a huge export boom time, and we had a very strong dollar. This thing is a myth on both sides. The idea that we ought to cheapen the dollar in order to help exports, that doesn't work, because if you cheapen the dollar, maybe there's a slight help to exports for a moment, but if you cheapen the dollar, your prices rise, and so that inflation makes your goods less acceptable, less competitive around the world. You can't become competitive through the printing press. Like I said, otherwise Zimbabwe would be the economic superpower of the world right now. They have 1,000,000% inflation. They have the weakest currency in the world. We grew in the second quarter because our economy is fundamentally strong and because productivity was there.
Productivity and an American manufacturing workforce, which is a lot stronger than people think. Vince Farrell, banks had a banner day. Banks had a banner day. And I want to come back to another theme. lower oil prices. This gust of this hurricane is not stopping oil prices. People are looking down the road. There is conservation. There is lower demand. There is also more drilling coming no matter what Nancy Pelosi says. And now that she's signed on with Boone Pickens for natural gas, she may be learning that natural gas has to be drilled for, too. There's no immaculate conception. So we're talking about lower energy prices. That solves consumers. That solves mortgage payments. That, in turn, solves the mortgage loans owned by the banks, which have to be marked down. And I want to re-raise Laffer's point. The upward sloping yield curve is a healthy sign for banks and financials.
Let me give you two other healthy signs, if I may, Larry, because I agree with everything you just said. That upward sloping yield curve is exactly what the banks need. But in this GD report, there was a drawdown on inventories of 1.4%.
$50 billion at an annual rate.
That kind of builds in productivity, or production rather, in the third and fourth quarter, because inventories were lean to begin with. The inventory to sales ratio is the lowest it's ever been. So if inventories had been neutral, GDP would have grown at 4.7%.